discussion started.
Thanks, Allie. Welcome, everyone, and thanks for giving us part of your day today. I'm Tim Lewandowski, and I steer the ETD-FX efforts for Eurex in the Americas. We're happy that you joined us to capture some FX insights and chime in on our discussion. So why are we here today, and what knowledge do we hope you walk away with? Well, quite simply, an updated understanding of the changing FX landscape with a deep dive into some real-world use cases from participants across the whole trade cycle, who you'll meet shortly, and really highlighting the expanded access routes we're fostering in FX futures. Deutsche Börse Group has been quietly building a massive FX footprint that spans OTC, ETD, and OTC cleared FX. It's a very disruptive business plan and not jailed by existing paradigms. Trends we've anticipated have come to life, and we've created what we think is a really useful toolbox for many use cases, a real supermarket of FX with a lot of depth and breadth. So the key takeaway here will be that legacy approaches to trading FX and FX futures specifically are no longer optimal, and that Eurex listed FX should become part of any best execution strategy. The price of continually doing the same thing can be far higher than the price of change. And you'll see that we've created many new attractive alternative sources of liquidity, and there's no one-size-fits-all solution, which our roundtable will talk about. So we'd like you to consider all of our execution silos with aims to find smarter ways to interact with today's FX futures liquidity. So moving on to the next slide, just an overview, excuse me, of how we'll look at things. Well, via views from the seat of each participant across the FX trade cycle. We'll start with some trade ideas generated by economic views into benchmark European currency pairs from Bannockburn. Then we'll move on to a Q&A where a buy-side participant, MASA, might model these trade ideas, potentially using a specific RCM execution strategy to touch the market through prices provided by one of our liquidity providers, flow traders, via the most efficient trading vehicle we think is out there, which are Eurex FX futures. So moving forward, again, to the agenda, maybe if we can have each of the panelists please make a brief intro so our viewers are aware of who is here.
Great. Maybe I'll go first. This is Marc Chandler. I've spent my career in various capacities. I'm really fascinated with the foreign exchange market, $6.6 trillion a day turnover. I tend to help clients. I spent most of my career helping large institutional corporates as well as asset managers navigate the foreign exchange market, advising strategies, that sort of thing, provide commentary, hopefully some color and insight. I began my career on the floor of the Chicago Mercantile Exchange as a reporter, and I was there shortly after they gave up the chalkboards where people used to write their bids and offers. So it's a pleasure to be here today, and I'm now fascinated by learning more about the evolution about the futures market.
Hi, I'm Connor May. I'm the head of trading at MASA Capital. MASA is a quantitative investment advisor based in New York City. Our team specializes in quantitative investment strategies that span asset classes and time horizons.
Hello, everyone. My name is Hector Robles. I'm with RCM-X. We're a financial technology company launched in 2017. We work with buy-side to provide premium algorithmic execution strategies and quantitative trading products. Our firm specializes in market microstructure. Our founder's DNA was in stat arb trading and quantitative trading before spinning out and launching RCM-X.
Hi, I'm Josh Matthew. I work here at Flow Traders. Flow Traders is the largest liquidity provider in ETFs, one of the largest. And I run the FX business here at Flow.
Great. Thanks, everyone. Maybe moving on to the next slide, just real briefly before we dive into the economics with Mark, let's take a quick look at the vehicle and Eurex ETD FX offerings. So leveraging our dominance in Europe across other asset classes, we've seen strong growth across our ETD complex, even considering the challenges of launching these new products within COVID. 2021 is on pace to surpass last year as far as volumes go, as our critical mass of participants increases. And this is definitely or partially a result of our increased universe of clearing firms supporting our vision to become the home of the euro. Europe and our matching engine are in Frankfurt, so is the ECB. So that makes for a logical new home for price discovery within the Eurozone. We've launched with 7 currencies, forming 12 initial pairs. The strongest participation, to no surprise, has been in the euro-dollar pairs. And there's several unique liquidity pools, which we'll touch on in a minute. But with regards to the products, we offer physically delivered FX futures and options, albeit with much improved specs, which we'll see in a moment, the ability to trade the spreads throughout the curve, and a clever rolling spot future, which is essentially a cash-settled perpetual contract, which never expires until you flatten it. That's basically a one-day futurized spot vehicle. As far as our roadmap goes, we'll next offer the ability to transact flex futures and options, where you'll be able to flex the value date. We'll expand to geographically logical Scandi pairs and Asian and Latin American products. So we're trying to be true new stewards to the European FX landscape. Moving on to the next slide, before I hand it over to Mark for a look at the currencies themselves, I'll just wrap it up with an answer to the question, why should we be taking a closer look at Eurex futures? Why do we feel the makeup of our specs are superior, and why are they attracting new buy-side flow? We'll touch on all this later, but the theme is that our products are crafted to look like OTC FX. There's a standard notional of 100,000 of the first currency in the pair. All the products are quoted in true OTC convention, and there's a flat execution fee for all users, 30 cents a contract for props and indirect buy-side flow in MASA's peer group. So as we'll talk about in the roundtable, one of the most vital specs to take note of is our tick sizes. Our tick sizes are aligned with the most granular quotations, a la the OTC market, where, for example, the euro is quoted out to the 5th decimal place, thanks to our LPs like flow. And this will have a massive impact on your cost of trade. So this is another key takeaway we'll touch on later during the roundtable. The combination of explicit costs, or the true execution fees, plus the implicit cost, or minimizing your execution slippage, which Hector will talk about, are massive factors that can dramatically impact and lower your total cost of trade. And that's going to be the takeaway here. Every trade counts. Most firms have an idea of what their explicit costs or the fees are for trading, but they haven't been able to substitute an alternative vehicle. Now they can, and our Eurex order book fees are extremely competitive versus the incumbent, where the incumbents are in many cases 3 to 5 times higher for buy-side participants in Connor's peer group. As we'll talk about later, we see that buy-side firms are also taking a more sophisticated look at their implicit costs as a function of tick sizes. And this drives home the importance of careful TCA and the savings that can be realized by utilizing the most granular product available. I didn't cherry pick this, but on the left, you'll see this Eurex FX futures top of book price versus the incumbents. And the takeaway here is this is consistently narrower. In fact, based on tick sizes, incumbent prices are potentially 10 times wider in many cases. So having more control over your precision pricing is a huge takeaway we'll talk about later. And again, I didn't really cherry pick this. This is a typical 20-day period where we've compared the Eurex top of book spreads versus the incumbents. Thanks to LPs like flow traders, during the month, our Eurex spreads in euro sterling, for example, here were tighter than the incumbents 92% of the time. So that's hard to ignore. So in closing, we really can't help you make money. That's up to you and your FX trading strategy, but we can help you save money, and eliminating some of these frivolous costs via use of more efficient tools is how. We've done a lot of portfolio analyses for German funds who've replicated or they've reaped significant costs by just replicating their existing strategy, but via these new vehicles. And we're talking about hundreds of thousands of euros in savings when you add up these cumulative costs. So if you ask someone how would they feel about decreasing the roll cost by 60%, I hope I know what the answer with that would be. So if you're not looking at these as an alternative, it's quite simply money out the door. And I'll just say that if you want a different result, you need to make a different choice. So the price of continually doing the same thing can be far higher than the price of change. So now that we've talked a little bit about the vehicles to navigate FX futures, let's go to the next slide and put some sizzle on the steak and capture some views of the fundamental and technical drivers of European majors. before we go into the roundtable discussion. Mark, the stage is yours.
Great, thanks. Good morning, everybody. So what I would like to do is just take about 10 minutes here and just go over some of the big macro views that are driving the markets. And I think picking up on what Tim said, focusing on the euro, and I'll focus on sterling and the euro sterling cross. As Tim showed, those futures market looks like it's even better than the market that I'm usually dealing with our clients and asset managers and corporates, especially in the spot and forward market. I sort of think of the euro as the Uncola to the dollar's Coke, the 7-Up, if you will. So it's the second biggest currency, as you know. And my broad sense, I think that the dollars, broadly speaking, the dollars had 3 rallies since the end of Bretton Woods. And what this chart really shows you is really the I think is that the tail end of what we call the Obama-Trump dollar rally. The other two were the Reagan dollar rally in the early 80s, ended at a Plaza agreement in 85, and then the Clinton dollar rally, the tech bubble, around the second half of the 90s. Coming out of the great financial crisis, you can see how the dollar recovers. That is, as the euro is falling, this is the dollar's recovery. And my general sense is that third dollar rally is over, which means that on a trend basis, I'm looking for a higher euro. And at these levels now, we're trading around 121 today. It still seems to me relatively low, relatively cheap compared to where we are in a big cycle. You know, we're just like after the global financial crisis, same thing after in the early days of COVID, the US has responded more aggressively, monetary policy and fiscal policy than other countries. And that led to divergence as a big driver. And that divergence, I think, is a temporary thing because the slowness that Europe had to roll out the vaccine and the slowness of Europe on fiscal policy just sort of postpones, but does not negate the idea that they're going to recover. And I think that's going to be really the second half of this year's story. The divergence mean that's really been the driver for the past year or so becomes the opposite. Divergence becomes convergence. And typically, the US needs to have higher interest rates to attract flows into the US when we have a large trade deficit. And today's trade deficit reported just a couple of hours ago was a record size in the US, record trade deficit, and these large budget deficits. And without higher interest rates, which the Federal Reserve is likely to tell us this afternoon, they don't anticipate coming anytime soon, that puts more pressure on the dollar. But the more interesting currency, perhaps in the euro, and maybe that's on the next slide here, if we can get that, is really sterling. You know, the world began anew in some ways with the, I'm sorry, if you go back to the other slide, just cable sterling. What you really see is that you know, imagine that on the eve of the great financial crisis, sterling is trading above 200. We got to 212 or so, and after the global financial crisis, you can see on this like little annotated chart that the sterling is still lower than it was in June of 2016 when they had a referendum to supposed to be a non-binding referendum. And it turned into a binding referendum, and the UK votes to leave. And I think this is really where the interesting opportunities are for the short term and for the long term. Let me talk just a little about the short term next week. I know that that's a very long term for some of the flow data and flow traders who are worried about what's happening in the next hour, the next 15 minutes. But for a lot of traders, thinking about next week seems to be within their time frame. Next week has two big things. One is and they're both on the same day, which makes it easier. The UK election, local elections, and a Bank of England meeting. The local elections will be the first since COVID, and it'll be in some ways a referendum on how Prime Minister Johnson has handled the COVID crisis, as well as Brexit. And Brexit, you know, even though as the chart shows, you know, Brexit proper, the UK left in January, but we still live in a world in which it's very much a key factor. It had dampened trade in the beginning of this year as they imposed, as the new regulations and new customs checks kicked in. But also, what's the cost of Brexit? Well, we're going to find that out next week when it looks like Scotland is going to have, they're going to have they're part of the local elections, of course, and they're likely to give the parties that support Scottish independence a majority. This is going to set up for a clash with London and a clash with the UK government about whether they should have it, whether they can have a referendum. Part of the trick, of course, is what they do if they do get their independence. What's on the other side? Will the EU welcome them? On one hand, the EU might not really want to facilitate or to encourage parts of other countries to leave, to join the EU. Many countries in Europe, including Italy, including Spain, have parts that want to break away and have independence. And so if the EU were to grant Scotland, were to assure Scotland they would be able to join the EU, that would encourage these separatist movements in other countries. On the other hand, the way the UK has handled the Brexit negotiations, the unilateral dropping of custom checks on the Northern Irish border has really aggravated the Europeans, and I think they look for a reason to punish the Brits. But the other thing that happens too, it's kind of interesting with the election, because in Wales, 16 and 17-year-olds are going to get the right to vote for the first time. This is really, in some ways, some other countries have it. In some US states, in primaries, people below the age of 18 can vote, 16 and 17-year-olds in some states, in some primaries. But this is really, I think, an exciting time. I mean, increasing the franchise. And I know a lot of people are a bit cynical, saying that 16 and 17-year-olds won't vote because we know that 18-year-olds don't really vote. But I think with education over time, as issues change and gather their imagination, like environmental issues, I think it's an important thing that I would imagine that other countries will follow, even if it's some lag time. So we've got the election, local election, a referendum on the UK, on Prime Minister Johnson, on COVID and on Brexit. Scotland was not in favor of Brexit. And so, and they've handled the COVID crisis fairly well by their own measures. And so I think that the election will probably add some volatility to the to sterling trading because of the unknowns about this and the consequences. Really think through the consequences of Brexit. Scotland may leave. The Northern Irish Republic border has become violent again, as the sort of the Good Friday Agreement with the U.S. is endorsed and is a security provider for, a guarantee for, that has become challenged again. And so some people who perhaps are a bit cynical can see how the cost of Brexit is sort of a fragmentation of the UK. Now, maybe a way to express this, maybe you could show the next chart, which is our euro-sterling cross, which, as Tim pointed out, in the futures, the top of book is being able to get tighter than the spot. And here's I think a monthly chart of the cross, and I'm kind of excited about it, even though in the short run I'm a bit negative, bearish. We got to test those lows again, but I think that in the big picture we're going to see sterling have a different function in the world economy now that they're not part of the EU. So one thing that happens is sterling's role as a reserve currency might rise because it might become less correlated with the euro as it moves to its own beat, with its own fiscal policy, its own monetary policy. And its fiscal policy, EU members have to submit their budgets to Brussels. The UK doesn't have to do that anymore. So I like this cross, and I think that for those of you who are thinking about volatility, since Brexit, sterling volatility has been a bit above euro volatility, but I think that can move. Before Brexit vote, there were long periods of time in which euro vol was higher than sterling vol. So I think this is an interesting cross to watch. You've got the broad dollar view represented in the euro, and with the euro sterling, I think you have these Brexit and the Bank of England next week. Bank of Canada and Norway look to be the first countries to begin normalizing policy. Bank of Canada began tapering this week, and Norway, which I believe meets next week, says that they plan on raising interest rates by the end of the year. The UK is probably the next group of countries to adjust policy. The economy looks like it's going to be booming. Vaccine rollout's been successful, and they plan on opening up the economy June 21st, just around the time that some of those quarterly futures contracts expire. So thank you very much for your time. Just to give you just a broad sense of the macro developments affecting euro, sterling, and the cross.
Great thought-provoking insights there, Mark. It'll be interesting to see how really these historic events play out. So with that, why don't we move forward to the next slide and just open it up to the roundtable Q&A, talk about how we might maneuver these events, and here's some views from, again, these different parts of the trade life cycle. So if everybody can unmute and feel free to chime in as you see fit. I guess, opening up towards MASA and maybe RCM, in these periods of great uncertainty, like Mark's mentioned, when the markets are volatile and liquidity is drying up, it's obviously critical for firms to understand where the liquidity is and have the means to access it, either directly or indirectly. How do you guys define FX liquidity in the current environment at MASA and RCM?
Hector, you want to go first?
Connor, up to you. I think maybe the buy side.
So we define it as the likelihood of execution and also the impact of execution. Whether we're able to actually trade on those prices, whether there's been a lot of debate recently about phantom liquidity and how stable the liquidity stack is. And as we get to more granular levels of liquidity at sub-pip levels, if that's actually viable long-term, and the impact of execution, the markouts over time.
Yeah, great point. To add to Connor's point there, we look at liquidity as a measurement of how much one can transact without creating impact in the overall market and having those prices start to move away from you. Some of the basic measurements of liquidity that are out there might be that some people may look at the intraday bid offer spreads. They may look at sizes quoted for the top of so best bid offer in the market. They might look at intraday volume trading throughout the day. And these are okay metrics. One of the more interesting things that MASA started to touch on there is when you look at modeling liquidity, there's a fair amount of price models out there that one can use. You can look at something like Kyle Lambda's equation or a square root equation to measure impact. So if you've got to move size of the market, what is my cost of transacting? And we look at liquidity in that sense. So one can look at this in a kind of constant of saying, I've got a defined duration of time where I want to transact. As you increase your size, no doubt, as sizes increase, you're going to see a correlation with the cost of increasing as well in relation to your impact you're creating. Another interesting way to look at liquidity may take into consideration your trading in the market in relation to a unit of size around you. So if you're trading, let's say, 100 lot in relation to 1,000 other contracts with 10% liquidity, what is my cost of trading as a total unit of order sizes in the market at that point? Some things to take consideration when you think about liquidity is obviously time of days, the type of volume you're trading, the duration that you're looking to trade in. And really, the more importantly, it's become as very critical, especially during the pandemic, was volatility in the market. We noticed that as volatility spiked last year, some of the display liquidity started to thin out in the marketplaces. And if you were looking to trade the same size and the same defined duration windows, you were definitely having increased costs and from an execution standpoint, your side.
I agreed 100%. Maybe towards flow and RCM, I guess. So recently, Eurex fostered the largest block trade ever transacted on a European exchange. That was 30,000 contracts by a buy-side participant. So in addition to the order book liquidity, we're excited that Flow has taken steps to expand beyond their order book LP activity and act as a block liquidity provider, obviously ensuring both the on-screen and off-screen. So Flow, what are some of the benefits you think the users can get via block liquidity versus on-screen, and when do they look towards this? And maybe this is for MASA and RCM as well.
So, from our perspective, I think Hector defined liquidity in a very precise way. It's the amount you can transact in any asset without without moving its market price. And with that, there are certain considerations around how does the execution itself affect the market price, and is that dependent on the size? Is that dependent on the time of day, on the volatility? And ultimately, it's a mixture of the two that allows for good execution. And by good execution, we mean getting a significant amount of volume done without the market moving very much. And there are places for everything. So, if you're doing something small, that might be the place where, the on-screen might be perfectly adequate because the liquidity is very transparent. You can deal on it, and you can satisfy a number of constraints that you may have in place. When sizes get larger or they become much more material, given the circumstances, as a liquidity provider, it becomes important to be able to do the transaction without leaking the information, and that also applies to the consumer of liquidity. So, from our perspective, our job, our function in the market is to be able to provide liquidity for the right circumstance, for the right execution style to all our consumers. And there isn't a one-size-fits-all when it comes to this. So, we're very excited that we can provide liquidity over blocks and on screen through spot, whichever way it may be, because we feel it's important for us to be able to bind the ecosystem together.
Yeah, I very much agree with Josh and what Flo is saying here. Traders, our clients, when they often look at the market, are constantly considering the trade-off between market impact of trading too fast or trading too slow and having price risk transpiring in the overall market. So depending on their execution objective and what's happening in those circumstances of time, under normal circumstances, you may see participants step into the market and utilize a participation-based algo like a VWAP or TWAP, or trade more opportunistically like using an arrival price algo, and kind of transact and look to minimize impact in the marketplace, look to improve execution quality. That being said, there are times when the trader may deem that price risk is too great and they're looking to immediately transfer that risk onto someone else. That ability to say, am I going to go to market and simply sweep the book in the central book, or do I turn and transfer risk immediately via block with a liquidity provider may be the best option for them.
So for Connor, our block trade sizes are set by design at one contract. As a pure taker, what steers your decision to execute either bilateral off exchange via a block compared to executing in the club, like Josh mentioned? How do you determine the best execution vehicle?
There are a whole host of factors that we look at in terms of purely just as a function of cost, like what our FXPV rates are, how much it would cost to trade on exchange versus off exchange. Also the stated goal of the strategy and the time horizon of the strategy. If I have a short-term strategy that's trading, that's most likely going to be trading OTC via an API, or so it's either trading directly with LPs on an ECN or on exchange. For more medium-term and longer-term strategies, we can stretch that window out, and we have momentum-based strategies, we have mean reversion strategies. So it depends on the strategy and the goal of the PM, right? If my boss says, I want this done over the next 2 hours, well, that's a different mandate than saying, okay, we need to get this done over the next 10 minutes.
Ed, Hector, you guys recently connected in our colo, which is great. So we're happy that you guys are a new source for our participants. As an execution conduit or a solutions provider, what do you see then driving the customer decisions to, adopt use of the RCM tools for futures? How do you help them identify automation opportunities? What subset of the flow is eligible for automation via futures potentially?
That's a great question. I think if if we take a step back and look at the overall marketplace in the last, let's say, 3 to 5 years, we've seen fundamental changes in the overall microstructure. So just the way that people are transacting the marketplace might be changing from the traditional RFQs to streaming to block liquidity, all these different areas. When it comes to futures and kind of algorithmic execution, clients are I would say there's probably 3 main factors. There's a digitization effect taking place in the market today that's continuing from what we've seen in the past. There's regulatory pressures and kind of things that have benefited people to go kind of more automated. And then there's an ever-growing quest for improved execution that are really the 3 main drivers. From a digital perspective, really throughout the pandemic and even before that, if working at a trading desk is incredibly hectic. There's lots of stuff happening for traders and they deal with a variety of different things throughout the day. If there's a way that they can automate some of the processes once the execution objective has been made, why not? So we're seeing just natural flow from a digital aspect in that space. MiFID and kind of best ex requirements ushered in this new era of people having to document and measure performance going forward. That resulted in, once everything was documented and measured, with the adaptation of TCA, many clients then took on a quest to improve overall execution performance. When they did that, they looked to measure not only their in-house proprietary algos against maybe an A/B test against a third-party provider, but it also allowed for the clients to measure their kind of in-house prime broker solution that they have been using previously against a premium provider.
Yep, agreed. I think that's where the TCA and the granularity of our specs are tools, that our participants are starting to look much closer at, because it adds up, like I mentioned. So maybe back to flow. As an LP, how do you quantify good flow from the buy side in an ETD market coming from someone like Connor? How can those users achieve better execution outcomes trading against your liquidity?
So I think, we take a step back. The first thing we like to do is to be as close to the originators of the transactions as possible. And that's important to us, because we don't want to be going through a number of hoops or hops before the transaction actually gets to us. What that then allows us is also to have conversations around exactly how to best execute, and that's materially important, because as everybody alluded to earlier, it really depends. If you've got a mandate to deal over a couple of hours, the flow is likely to have a lot less market impact, and that's really the key. We like to understand what the anticipated market impact of the flow is, and then we put that together with the anticipated risk that we're taking on as a result of having that flow. And those two kind of items together allow us to give a price on which we put the liquidity that we're showing at. And clearly, the less market impact, typically, the better we would see the flow as.
Sounds logical. Maybe going back to MASA. So I think we all agree that execution is an art as well as a science, yeah. And we see the bridge between ETD and OTCFX narrowing. I'm curious about thoughts on these new tools. We're the only exchange ever to offer, so I wanted to mention it here, which are going to be streaming futures blocks trades. And how do you incorporate these and potentially determine which is the best vehicle for execution on the fly? Are your strategies helping with that, or do you take a look at your liquidity sources and then pick and choose where you do your risk transfers, or how you do your risk transfers?
Sure, we incorporate that into the strategies. And I think as part of the Best X mandate, you have to be agnostic over where you execute, as long as it's the best venue. And Best X doesn't include just cost; it includes likelihood of execution and repeatability of execution, right? So I think you have to incorporate all liquidity sources. And as we've seen over the past couple of years, futures exchanges are buying spot and forward providers, right? Execution venues. So I think that only gives the buy side a deeper toolkit.
Yeah, that was our design, definitely. I think, like I mentioned before, a supermarket of choices. Every customer is their own snowflake, and they're not all going to touch all the different tools, but there seems to be a tool there for everyone, and that was our design.
You don't have to use it on it. You don't have to trade futures on every day, but over time, it should be part of your toolkit.
And it sounds like you're seeing that as part of your evolution. Yeah.
Yeah, definitely. I mean, from the buy side perspective, a lot of people historically just traded futures because they didn't want to get involved in the FXPB relationship, and that the pendulum swung to where more people were trading via an FXPB or bilaterally, and now it seems like exchange traded derivatives are making a comeback as well.
Maybe skipping back to flow. So again, we're quite happy that you guys added the service to act as a block liquidity provider. What's your motivation providing both the on-screen alongside the futures when people might look at your screen prices and then execute a block OTC?
Yeah, so Eurex has been very smart here. There's always this conundrum around whether the lit liquidity is adequately rewarded when there is off-exchange transactions going on that is often anchored to the prices that are visible on screen. And here, Eurex has done well in mitigating those risks and alleviating those concerns that we've had by allowing us to participate in the revenues that are created in the blocks as well, just by us providing the liquidity on screen, which allows the price to be anchored somewhat.
Yeah, and that was definitely by design. For those of the LPs who aren't aware, 50% of our revenues are shared with LPs like Flow. So, this is a long-term cooperation strategy that I think has paid good dividends for everyone involved in other asset classes. And it's really about baking a pie for ourselves and having 100% of a small pie, or rewarding our anchor partners and everyone shares in a bigger pie. So that should be interesting to see how that develops. Maybe going back to MASA, I think, credit is core, obviously, and the cost of FXPB, like you talked about, and bilateral credit is clearly changing. So how has your execution evolved over the years? And has that increased your motivation to look at futures because of some of the relief that it provides?
Yeah, I mean, it's definitely has been part of our execution strategy, and with the rollout of UMR, it's definitely increased the attractiveness of futures. It really hasn't changed for us over the past couple of years in terms of how many futures we trade or how active we are in futures, because it's always been part of the strategy.
Yeah, well received. Back to Flow, how do you see your interactions changing with the modern FX market, like Cotter mentioned, the various venues they trade on, where you provide liquidity? Have you seen the ETD develop alongside OTC over the recent years?
Well, if you go back a long way, the FX spot market has changed a lot in the last 20 years, going from, mostly transacted by banks and the wholesale market being predominantly, on two major clubs. Lots of new ECNs have been built up. The CME has gained volumes, and obviously now Eurex as well. So we're seeing, the fragmentation, at least in the OTC market, reached a peak a few years ago, and is now somewhat consolidated, at least on venues. I think, the bilateral space is still possibly the cheapest execution method for most participants, at least who are able to have a PB relationship or where credit is not really a concern. But certainly the futures market has made somewhat of a comeback, and we can see it in the volumes that we're currently doing. And I think part of that is the fact that credit is not so easy for a wide range of participants. While the connectivity puzzle has been pretty much solved, the credit puzzle hasn't quite been fixed, and there are still several hurdles for people to be able to trade with the best possible price they can see. And I think the futures market here has a big role to play.
Yeah, well, I think that's a great segue, Josh, into like some current events. I mean, I think we all agree that the old OTC FX markets will not stay as they were. UMR is delayed but inevitable. Regulatory demands will force users, onto a cleared platform in some ways. So, we observe the bank expanding to serve both segments of FX via a hybrid model, both OTC and ETD. And it sounds like Flo, you're involved with that. Maybe, to Connor, considering the massive impact of the Archegos debacle recently, do you see those type of events potentially having an impact on the FX market and the traditional PBs and clearing landscape?
I mean, Archegos is equity prime broker specific, but I guess there should be knock-on effects in terms of the FX PB landscape. And as we've seen over the past 20 years, like there's only been a trend towards fewer PBs, which is an issue for the buy side. And whether you're for corporates, for anyone that trades FX, they should be concerned about that. But so it's something that we actively discuss with our PBs. We pretty much only engage with top tier providers who have very solid credit. So it's not a risk of, is someone going to pull the plug on us today or tomorrow? And we actively manage the relationship. That's one of my primary responsibilities at MASA, is to manage our relationships with our PBs, whether equity or FX.
Yeah, and I think it's important to mention that as well. Definitely fewer PBs. I think we've seen a trend into a concentration into fewer PBs. And I think that segues perfectly into our aim on how we scope our products, really to, to have FX futures as an alternative alongside OTC FX. I guess one more question on that front, a few of these big names get burned and things can change for the long haul because there have been some pretty big names that have taken big hits. So do you see ETD providing a cleared FX trade at a price point that's comparable to a bilateral trade? How do you make that apples to apples comparison?
Was that for me?
Yeah.
So it's, as I said, our FX PBs are very stable and have made a huge commitment to their business. But and they've also indicated that they're agnostic between whether we trade via an FX PB relationship or if we clear futures with them. So they are just looking at the relationship holistically, because they realize that the customer wants to get best execution and trade across venues. So they have to be able to provide that to their customers.
But if I can maybe add something to that point there, is from previous experiences being on the sell side at banks, we understand that in order for these banks to provide FXPB to their clients, there's a cost of internal capital on their side as well that they must undertake in order to provide these services to their clients. With UMR, that I think someone referenced earlier today or earlier on the call, becoming a reality as the cost to transact become more and more expensive for the FXPB providers. At some point, if those costs are passed on to their underlying clients, that increase in cost on the OTC side may thereby increase in interest, or might kind of create a situation where the FX futures products become much more interchangeable between the two products, between the OTC and the future space. That's one of the reasons why RCM-X decided to support the Eurex FX products, because we do believe it's interesting in the space, especially as we go through another change in that space.
Yeah. Touching on what I mentioned before, Hector, are you seeing that the best X practices are becoming more high profile? Because I said we were really amazed at some of the analysis we did and the cost savings of, doing the same thing over a couple rolls over the course of the year. And again, these implicit costs adding up.
So I'll confess in that we're not the best at keeping tabs on the cost of what one product may cost at one exchange versus the other. But what we have seen is definitely fundamental change post MiFID, post BESX really become a priority. Where I would say in two cases. One has been where traditionally in futures, most participants in the market would have transacted using their primary broker, maybe their secondary broker. If they had their in-house proprietary solutions, they would just route all flow through their primary clearing broker from an a PV perspective. If they were using a third-party provider, that would have probably just been their clearing brokers, algos in that space. We're now starting to see a shift similar to what we've experienced for many years in the equity landscape, where in equities, if someone trades, more chances than not, they've got, let's say, 4 to 6 different counterparties and different algo providers that they may leverage to trade algorithmically in the market space in equities versus futures that may have only been 1 to 2. In the last 3 years, we've seen people actively look to measure the actual execution performance, and you're seeing that number grow from the traditional, maybe using your primary clearing brokers, algos, to taking on best practices where you're now measuring across 2 to 4 different providers in this space. We're also seeing a shift from traditional, let's call it CTA, kind of asset management usage of just pure participation-based algos of VWAPs and TWAPs to more opportunistic type trading algos like arrival price. I would say that those are probably the 2 biggest shifts we're seeing.
Maybe going back to Connor. So I'm curious on your views on what might drive more buy side flow towards ETD, where flow is providing steady prices all day long now, 23 hours, just like the OTC market, OTC like specs. I mean, alpha is obviously more than just higher trading profits. Yeah, it's important to minimize the trading costs when implementing your strategies. While bigger ticks concentrate liquidity at one point, is the ability to not be constrained by a wider tick important in this implicit part of your TCA?
Yeah, I definitely the tick size matters, and it's a chicken or the egg problem, right? Like if we get liquidity providers like Flow incentivized by Eurex to provide liquidity, then it's going to and events like this that enhance, that demonstrate that these products are available, then it's going to draw liquidity from either new liquidity or take it from other venues. So I think, as you get Flow and other LPs that are providing in multiple venues and that start making units, then you're going to have enhanced liquidity across the whole set.
Yep, definitely agreed. Again, so we're pretty proud, and I would say imitation is the best form of flattery. And I think if anything, we've seen our incumbents and competition come towards us, with regards to our specs. Obviously, Flow, there's a sensitive, a sensitive line to tap dance there between obviously market makers liking wider spreads to buy in the bid and sell in the offer, but being able to acquiesce more granular tick sizes because that's what the buy side wants to deal on. Yeah.
Yeah, no, I think that there is a right tick size for a product based on whether it's volatility or the amount of liquidity that you actually need to show in the order book to get executed for a certain amount, and it's a very, very important consideration. You want to prevent, you want to make the cost of execution not very expensive, and at the same time you want to be able to prevent certain practices that can occur by having very, very wide tick sizes, and it changes the entire trading market microstructure and the landscape and ecosystem in which consumers are trading at. For us, I think it is the step in the right direction to tighten up the tick sizes, to make them small, and I think it adds importance to the price you're willing to put on the liquidity that you're showing.
Agreed. And while wider ticks might concentrate more liquidity at one point, we feel that the more granular ticks really allow you to, execute or hedge at a price that's more efficient, quite simply. So, well, in the interest of time, I mean, it's been a great discussion. I think we could go on for a while. I don't know, Ali or Hector, if there's any questions from the audience in addition to what we got. How well does the exchange FX market overlap with spot in terms of tradable hours? I think we mentioned that earlier. It's, again, 23.5, just like the traditional OTC market. So pretty much OTC-like in our specs and accessibility is the takeaway there. We've got a couple polls here for you, Mr. Chandler. Do you think the euro finishes the year above or below 123.50? Okay, looks like a no. I can't give trading ideas, but I would give a yes. Are FX participants trading more futures now versus 5 years ago? Yes, I think MASA, you definitely drove home that idea and why you're looking at it. When accessing liquidity aside from traditional sell-side banks, are you now accessing liquidity on, it looks like, all the above? Futures alongside OTC, disclosed from an alternative provider, and anonymous on ECNs. Yeah, that's where I think, again, there's a price to be made for each trade. The streaming blocks, which we're offering, obviously, those are probably going to be wide but real compared to the narrower size that Flow provides in the order book on screen, in the anonymous CLOP. So I think that's the takeaway. We've had all flavors there for the taking. So I guess in closing, hopefully you agree that the futures markets are undergoing a change, and we're definitely trying to drive disruption here. And I think the takeaway is that the price of continually doing the same thing can be far higher than the price of change. So we view disruption as positive here. Deutsche Börse, Eurex FX, we have many parts, one body. It's truly an FX supermarket. And I think we all agree that the bridge between OTC and listed FX is narrowing. And the legacy FX future specs are no longer optimal. So please feel free to ping us with any comments or questions. And thanks again to all the participants and for all of the listeners for giving us part of your day today.
Thank you all.
Good luck.